So you just saw that risk, diversification reduces the risk by about a third. It's a huge risk mitigation tool. So my question is, does it actually work? So when you finish your paper, you can go read this blog. I've made this presentation to at a few conferences. It's a bit provocative to even ask this question, because in college you're just told, yeah, of course it works. That's what everybody does. But can we ask the question? And has anyone else asked the question? So let's look at the history of this. And this is out on Canvas. All right, so William, the pretty famous guy, and this, we're not talking about someone from the 19th century, you know, it's a pretty recent guy. So he says, diversification is a hedge for ignorance. I think you're much better off owning a few stocks and knowing a great deal about them. By being very selective, you increase your chances of picking superior performers. You can also watch the stocks much more carefully, which is important to controlling risk. For an investor, 2 stocks, 3 stocks, 4 stocks, 4 or 5, 6 or 7 stocks. So what is he arguing? Familiarity is far more important than diversification. You're far better off knowing what you have than you are diversifying a bunch of stuff that you kind of know. That's pretty radical. Maynard Keynes, he died a much longer time ago, but famous economist. As time goes on, I get more and more convinced that the right method in investment is to put fairly large sums in enterprises which one thinks one knows something about and the management of which one thoroughly believes. It is a mistake. He doesn't say, I question if it's good. He says it's a mistake to think that one limits one risk by spreading too much between enterprises about which one knows little or has no reason for special confidence. Again, they said diversification is horrible because you can't be familiar with that many companies. One's knowledge and expertise are definitely limited, and there are seldom more than 2 or 3 enterprises at any given time in which I personally feel myself entitled to put confidence. Now, I don't know how concentrated Warren Buffett is, probably more concentrated in most portfolios. We generally today consider a concentrated portfolio to have like 20 stocks in it. They're talking 2 or 3 or 4 stocks, very, very concentrated. Now, what's the difference between Keynes and O'Neill and today? Computers, digital information of, you know, you can get to know an entity pretty well with the computer doing all the work and, you know, doing quite a bit of analysis. So that's definitely a difference between now and Keynes. So it's a battle between familiarity versus diversification. Have we fixed the familiarity with the computer age? Especially when you talk about passive investing, where you just buy the entire market. That's something they definitely were talking about in the 30s and 40s. So what do we say today? Investment diversification, one of the basic building blocks of a solid portfolio. Diversification is the fancy name. Don't put all your eggs in one basket. It's the basic principle behind asset allocation. I don't even tell you who said this because everybody says it. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. The practice is designed to help reduce volatility of your portfolio. The goal is to reduce volatility of your portfolio. I remember at UTSA, it really bothered me that we didn't have like our we believes. This is what distinguishes UTSA from all of our competitors. So I wanted our we believes comments. And the committee got together and they're like, well, we believe in diversification. I'm like, yeah, everybody believes that. So it's like, let's not even talk about that. They started saying stuff that everybody believes. I'm like, no, what do we believe basically? And this is one of the first things they say. Make sure you diversify your portfolio. But yeah, we can't say that's the we believe for UTSA because that's just common. Everybody believes that. I'm saying that even though I'm questioning it. So I'm like, maybe I don't believe it, but you just can't say that. Why do we believe that distinguishes us from all of our competitors? This is not something you can use as a distinguishing factor today because everybody's going to say diversify, diversify, diversify. One way to balance risk and reward in your portfolio is to diversify your assets. The strategy has many complex iterations. It's simply by spreading your portfolio across several asset classes. They're not saying securities, asset classes. So it's not just having 20 or 40 or 50 stocks. It's having large companies, small companies, European companies, reducing the number and severity of stomach turning ups and downs. How did this work in 2008? We went through, man, I'm so glad it was diversified. I only lost 40% where I could have lost 48%. I don't know if that helped all that much. We'll talk about that. The promise and power of diversification is that much risk completely disappears with only a small impact on expected return. That's the idea. We saw that with the efficient frontier. As you diversify, as you add more assets, your return kind of modulates around, but your risk starts dropping really, really fast. But I'm going to ask the question in two ways. I got to watch time here because we lost our panel up here. So we're going to ask it at the individual security level and at the portfolio level. So your project 2, you're going to be doing this at the portfolio level. But we want to ask at the individual level. And then after I question diversification and I kick out everything you learned in college, I'm going to ask, can we replace it with something? I'm going to give you 3 alternatives, right? Or 2 alternatives. So I'm not going to just leave you high and dry. All right, the stock level. Should you have 1 stock in your portfolio or should you have 30 or 40 or 50 in your portfolio? Is there a better approach? So here's where capital asset pricing model comes in. Y'all know this backwards and forwards, right? You could write 50 pages on CAPM. So what are the 2 risks William Sharp came up with? The stock has systematic risk, unsystematic risk. Systematic risk, that's its exposure to market events like the economy, interest rates, inflation, geopolitical events. Unsystematic risk, those are those company-specific risks. Which of these does the market pay you a risk premium? Just systematic. What does it pay you for taking unsystematic risk? Nothing. Why? Because you can eliminate it just by diversifying your portfolio. I've heard that. I think we teach CAPM. Can you think of a finance class where they didn't talk about CAPM? Maybe in John Tuohy's class. Has he done CAPM? Anybody taking John Tuohy? Has he mentioned CAPM? Yeah, he mentioned it, but it's not a big part of his class, right? Because it doesn't really apply. But almost every finance class, you keep getting hit with CAPM. Is CAPM important? Yeah, you better know it. I remember studying for the CFA exam. I was in this class. It's like the week before the exam, and these 2 guys on the front row are like, what was that CAPM thing? I don't remember. It's like, okay, I think I'm ready for this exam. Because it's like, that was like 25% of the exam was sticking numbers into the CAPM formula. It's like, okay, give me more of those questions. I can handle three numbers. So it's a really famous formula. That's a big part of finance. You want to know what prize in economics for the CAPM. Obviously, it's a good theory. How much of an individual stock's risk is systematic versus unsystematic? Well, most of it's unsystematic. 70, 80% is unsystematic. Only about 20%, 30% of a stock's risk is systematic. So that means when you put 20, 30 stocks in your portfolio, you're eliminating a massive amount of risk of those individual stocks. Somewhere around 20 stocks, if you make sure they're from various industries, you're almost completely eliminating your unsystematic risk. It's not hard to do. In one phone call to Vanguard, you can eliminate 100% your unsystematic risks, but buying a stock portfolio, pretty easy to do. So here's the kind of picture of it. I took 10 companies and I combined them. So here, if you had just one company, here was its return and here was its risk, standard deviation. Then I put 2 companies in. The return was about the same, but what happened to the risk? The red bar, it dropped. The green bar is the average risk of the 2 companies. But the red bar is the standard deviation of the portfolio. So what do you notice has happened here? The average risk went up, but the actual risk of your portfolio actually dropped. Why? Because they're not perfectly correlated. They don't move exactly together. What formula might you use to figure out that standard deviation? Anybody have a formula we could use to figure out how we got this red bar? Maybe the weight of A squared times the standard deviation. Maybe sound familiar? Right? So that's that formula. And what happens when we add a third stock? What happens to the return? Not much difference, right? What happens to the risk? Now the average risk came down just because this was a less risky stock. The average risk came down, but the actual risk of the portfolio has dropped from 40% down to less than 30%. Out of 4 stock, the return's coming up because we're adding stocks with higher returns, but the risk just keeps falling and falling, even though and here it's interesting, right? The average risk increased, but the risk of the portfolio actually dropped and dropped and dropped and dropped. So the average risk was 30%, but the risk of your portfolio was only about 18%. That's just with 10 stocks. You can gradually reduce the risk of your portfolio just by putting. And I do believe you should diversify a stock portfolio. I'm not recommending you put all your money in 1 or 2 stocks. So how much did Warren Buffett have in Apple at one point? Did he get above 20% in Apple? I have to look into, I mean, I guess if you count Geico and Jim Reed, probably not, but he had some pretty concentrated exposures, but probably not 60% of his portfolio. So here's 10 stocks where you have 10% in each stock. And just by going from 1 stock to 10 stocks, you've reduced your risk from 40% to about 18%, and your return actually is slightly higher because the return is just the average of returns. But the risk is definitely not the average of the risk, is it? That's what the green bar is. The risk is a much, much lower number. If we went out about 20 stocks, we'd probably end up looking just like the market pretty closely, depending on the beta of the individual stocks. I'm not going to show you that chart. So diversification does an excellent job of reducing company-specific risk. Unfortunately, that risk reduction is not stable over time. What does unsystematic risk do during a crisis? So here's the percentage that is systematic risk of a stock. You want this to be really low. You don't want all your stocks moving together. 90% of the risk be company specific. And so you can see here, I mean, isn't this amazing? This was the systematic risk of those 10 stocks. Less than 10% of their risk was systematic. Over 90% was company specific. What happened in 2008 though? 60% was systematic risk. How did diversification help you in 2008? Almost not at all. Why? Because everything was crashing. It didn't matter what company specific risk was. It's like, hey, we had a good quarter of earnings. Yeah, your stock just went down 20%. Could have gone down 24, but we had 20 because you had a good quarter. Everybody was just crashing. I think Walmart was the only S&P 500 stock positive in 08. Just everything was crashing. So what does that mean? How does diversification at the individual security work in a crisis? Far worse than in normal times. What would you like it to do in a crisis? You'd like that to be the best that it does, but that's the worst that it does. You hear me say that about finance over and over again. Our risk tools in finance work really well until when? When you really need them, then they don't work very, very well. So that's the downside. I still believe you should diversify at the stock level, but just realize if you go into a crisis, your portfolio is not going to feel that well diversified. It's some going to feel like you have concentration risk. It doesn't matter if you have banks or whatever. Everything's crashing. There's 1 bank in these 10 stocks, but there's not 10 banks in these 10 stocks. Everybody understand this chart? Now, anybody know how I calculated systematic risk? Anybody remember that? I think I mentioned it in a previous class. So if you have your weekly returns of your stock and the weekly returns of the S&P 500, how would you calculate the percentage that is systematic risk? It's a real easy calculation if that helps you. Let's see if I can find an example for you. So Abbott, y'all heard of Abbott? So there's Abbott's daily price, S&P 500, their returns. The beta is 0.65, but that's not the systematic risk. That's the measure of the kind of systematic risk they have. Are they a cyclical or defensive company? So what is Abbott? Beta 0.65 must be defensive, right? But that's not their systematic. What percentage of the risk is systematic? So you may want to guess what formula that is. I'll do correlation of Abbott to the market squared. It's R squared. Y'all heard of R squared, right? How high can R squared be? 1%. How low can it be? Not -1. That's correlation, but R squared. 0, right? That's the percentage of Abbott's return that is systematic risk. So how much of their risk is unsystematic risk? So 24% systematic. How much is unsystematic? That's not right. But so most of the risk, 76%, is unsystematic risk. It disappears when you diversify in the portfolio. Only 24% of the risk is tied to the market. See how easy that percentage that I got is? You just get the R squared of each stock versus the market. You notice here, this is the median of the 10 stocks. So I took each stock and did their R squared to the market, and I just took the median of that. And in 1993, it dropped down to like 5%. In 99, it dropped down to 5%. And then you had the 2000 crisis, jumped up, 2008 crisis. I don't know what it is today. I haven't updated it in a while. I should update it. It's pretty easy. R squared does tell you how much of the bank's or company's risk is systematic, and 1 minus that is how much is unsystematic. That tells you how much diversification benefit you have in that stock. What can we say about this line, about its stability? How predictable is that? How reliable is that? It's not very much at all. I do need to update it because I'd be curious to see what happened in 2020 with this number, just to see how impactful it would have been. Here's beta. This is Walmart's beta. What do you notice about their beta? Yeah, it was a smaller company back here, and it actually went negative. In 2008, it went negative. That's a great thing. So if you had 100% of your portfolio in Walmart in 2008, you would have been pretty happy because you would have made a small return. And their correlation, their beta actually went to -0.2, and it jumped up to 0.8 for some reason. What kind of company is Walmart? Cyclical or defensive? Obviously defensive. So their beta should be well below 1. That's what you expect. But as a small company, it's going to be higher, and then it comes down over time. But what else? What do you notice about beta? Very unstable. So not only is the amount of the stock's risk that's systematic, not only is that shift, but whether they're cyclical or defensive, that changes over time too. I mean, did Walmart, were they like selling cars here? And then they started selling rice cakes. And then right here, they decided to do big screen TVs and nothing else. And then say, no, let's go back to rice cakes. Or did Walmart do essentially the same thing the whole time? For some reason, their beta kept shifting around. And why does beta shift around? Well, that's kind of, if you look at the capital asset pricing model, it kind of assumes beta as a very predictable, stable number. It's all over the place. And I think the reason it's all over the place is not that Walmart's changing, but what's driving markets is changing. So in 2000, it was tech stocks. If you weren't a tech stock in the 2000s, I don't know why Walmart would have jumped up then, but if you weren't a tech stock, your beta was probably low and tech stocks were high. 2008, if you're a bank, your beta was really high. If you weren't a bank, your beta was probably lower. So certain things drive certain things, and certain systematic risks dominate markets at certain times. You know, inflation, interest rates, or certain things that are driving at different times. All right, so I believe in diversification and individual security level, but it's not the most reliable thing in the world. It's going to come back and bite you at the worst possible time. It's very unreliable in terms of your metrics because they're so unstable versus what you would expect. It's a bit frustrating, but diversify your portfolio. Don't put all your money in one stock. But what about at the asset class level? This is where academia teaches you to do this and never questions it. So I'm going to question it. Don't tell the other professors, but I'm going to question it. Does diversification work at the asset class level? This is that efficient frontier you're going to do on paper 2. Your inputs are expected return, expected risk, and expected correlation. And Efficient Frontier says there's some superior portfolio that has the highest return at every point of risk. And we love low or negatively correlated assets because they can greatly reduce the risk of the portfolio. So what's a negatively correlated asset? What asset does well when the U.S. stocks are crashing? What worked in 2008? Treasuries, long-term treasuries, they were up like 60%. There you go. How did they do in 2022? They were down 30, 40%. Okay, so one for one, 50%. What was up in 2008 and up into 2022? I bet you can't think of anything. You might say gold. Gold loves a crisis. Gold loves inflation. How did gold do in 2022? Not very well. Tips, maybe how did tips do in 2022? You would think inflation bonds would have done well. They didn't do well. They were down. US dollar, maybe? Why did you just sell currencies of other countries? How did they do? How did the dollar do in 2008? I can't even remember. I should be able to remember. I can remember a lot from 2008 because I didn't sleep much that year. Oil did great in 2022. How did oil do in 2008? Probably not so great. So what do you notice about 2008 versus 2022? 2008 was a financial crisis, a recession. 2022 was inflation. Two very, very different things. Is there an asset class that is consistently going to protect you in both a crisis and an inflationary environment? That's where I'm going to give you the alternatives. How do you think about this differently? So if you say, hey, I'll just put my client in long-term high-quality bonds because you saw what happened in 2008, what are you doing? Saying, well, I'm assuming inflation is never a problem ever again. Is that a good assumption to make for your client? So it's tough. Are there truly, and I guess what I should say here, a reliably negatively correlated asset, but there aren't any negatively correlated assets that are reliably negatively correlated all the time. So expected return, how do we get that? We're going to see that with paper 2. For bonds, I just use whatever their current yield is. So treasuries are yielding, what are they today? 5.2%. Treasuries using 5.2%, that's what I forecast my return. High yield, not so much. High yield, I'll subtract out some because some of them are going to default, but that's my return. For stocks, y'all have had me before, Stocks give you a current dividend yield plus expected earnings growth. I actually read an economist article this week that said that exact same thing. Dividend yield, you might adjust for stock buybacks, but you're talking 6 to 8% return kind of assumption. Alternatives, who knows? It's a function of supply and demand. What's the return on nickel going to be in the next 20 years? That's a tough one to do. Or cobalt, who knows? These are really tough things to project. Currencies, how do you project currencies? It's all over the place. So who knows? Expected risk and correlation. The expectations are pretty stable over time, but the actual numbers themselves are pretty volatile. So here's a bond return. This is the average yield. And this is the return over the period. This is the start. So the average return for the whole period was 4.97. The average was 4.97. The return for the whole time was 4.4%. The blue line is the starting yield, and the red line is what you would have gotten in the next 4 or 5 years. So essentially, I'm saying use the blue line to predict the red line. And you can see it doesn't do a great job, but it's not horrible. So here, when interest rates really rose, bond prices fell. Your projection for bonds would have been much, much, much higher. Here, interest rates fell, bond prices soared. Your forecast would be a little bit off. But over time, the starting yield is a pretty good forecast for bonds. It's not that difficult to project bonds. For stocks, some of y'all have seen this before, the dividend yield plus earnings growth does a pretty good job of projecting stocks over time, but right now stocks are well above that line. Stocks have gotten ahead of themselves. So I should have updated this one. I have updated charts, but I didn't put it in this presentation. But the red line is the dividend yield and earnings growth for every decade. And the blue line is the actual return on stocks. And you can see for most of the time, the slope is pretty good. Here's 2008. And since then, it's just been kind of soaring up above. But I do think that's the best estimate for stocks is the current dividend yield plus earnings growth. We're not going to get into that in this class. In my investment class, we talk about it quite a bit. So I just think stocks should get you a 6 to 8% return. Tomorrow night in Investment Society, I'm going to talk about what The Economist has been writing about this recently. They're asking the question, is the U.S. stock market in a bubble that's going to burst? So I went through their two articles. I highlighted their negatives in red and their positives in green. There's a lot more red than green. So what are people hoping in the stock market? What's going to save the stock market? The AI, right? So AI is going to produce all these wonderful new earnings and all that kind of stuff. Who knows? In the past, what's happened, the market really hyped a particular technology. Did it end very well for the stock market? Usually it was pretty horrible at the other end. But I do think that's a good estimate for stocks. We're not going to get into all of these. Here's the standard deviation of the major asset classes over time. So you need an assumption. This is large companies here. I'm not sure which line it is, probably this line right here. So you need assumption for your client. What assumption do you use? If you use this assumption down here, you're telling your customer stocks are not all that risky. Right before the 2008 crisis, if you use an assumption up here, you say stocks are incredibly risky, so they take all their money out of stocks right before the major rally in stocks. So what can we say about the standard deviation of markets? Very unstable, very unreliable. What is something, you just go in the middle point, halfway point, and try to forecast it, use 15%. What is this, emerging markets, 33%, or as low as 15%, or as low as 13, 12%. Very unstable. So you got to make a forecast, but historically, risk has been doing that. It's really, really tough to figure out what risk you're going to do. Which line looks the most stable? Fixed income. Fixed income's pretty stable. Yeah, fixed income's not that risky of an asset class. It's fairly consistently not that risky. All right, so we talked about this earlier. 8 sigma days. How often should you see an 8 sigma day? Never, right? Every trillion years or so. So in the 80s, we saw 3, all of them related to the October 87 crash. In the 2000s, we saw 5, all of them in 2008. I think some of them we saw in the same week, all in the last quarter. So this is, a few months before my retirement date. So I'm kind of glad I'm retiring because it was not a fun time to be in finance at all. Really, really rough. We saw days when the market fell 11%, was up 11%. It was just crazy, crazy, crazy stuff. So I don't know where I got the 6 trillion years from because you can't actually do this in Excel, but it shouldn't happen very often. I'm saying you should see one of these. We saw 5 of them in 2008, and then you bring 2020 in. 2020 had 3 or 4 as well. Most decades, not at all. So yeah, most decades shouldn't have any at all. But how many should we have seen in this chart? Shouldn't have seen any. I mean, maybe one freak accident, but you're seeing, 8 right there from that. So standard deviation, our measure of risk says none of these happened. And they happened. So did we see 1 in 6 trillion year events in 2008? Or is there some problem with standard deviation as a measure of risk that's understating risk in some way? Here's correlations. What do you notice about correlations? A little more stable between stocks, but still kind of bouncing around quite a bit. Here's high yield. That's not a stock, that's a bond. But what do you know? This is the key we're going to spend quite a bit of time on. Here's bonds. What do you know about fixed income? So are bonds and stocks positively correlated or negatively correlated? The answer to that is yes. The answer to that is yes. But yeah, generally we think negative, but not always negative. So when are stocks and bonds positively correlated? When are they negatively correlated? Positively during inflation. Positive during inflation. 2022, what happened? Bonds dropped 20%, stocks dropped 20%. Why? Inflation. All right. So are stocks and bonds probably positively negatively correlated? And we're going to look at some people who are going to say that's the wrong question. Correlation doesn't tell you anything except for what happened historically. It tells you nothing about the future. Correlation is an artifact of environment. So we're going to hear this word environment. The key is the environment. Was it an inflationary environment? Was it a recession? Was it a growth environment? Was there something geopolitical going on? It's the environment that matters.
So I was going to say that risk measurements fails to account for human psychology.
Yeah, that's part of what Andrew Lowe's talking about in his adapted market hypothesis, is that markets change over time because people adapt to markets and they change their behavior in response to history. That's the problem with using history to forecast the future, because history changes us. The future is going to be different because we lived through history. So, it's hard to use the past. But stocks and bonds is probably the most important thing, because the overwhelming majority of Americans have three assets: stocks, bonds, and their house. And that's it. And what happens in an inflationary environment? Their stocks and bonds are both going to blow up. 2022 was a pretty horrible year for most American investors, because they thought they had diversification, but they didn't. That's spring 2022, and I have to update all these charts here. Here's 2008. Large cap were down 42%, small cap down 48%, developed down 44%, emerging markets down 48%. How did diversifying your stock portfolio help you? By asset class. What do you wish you had? Had it all in large cap, right? That would have been nice. That would have saved you 6% on the loss. Yeah, what do stocks do in a crisis? Correlations go to 1. It doesn't matter what you have. It's just going to all crash. Bonds did okay, but that's mainly treasuries. If you look at corporate bonds, they were down 15, 20% in 2008. High yield was down. A typical 70-30 portfolio was down 31%. Horrible portfolio. So what can we conclude about this? On the individual stock level, diversification works, but it's terribly unreliable, and it works the least when you most need it. So for individual stocks, yeah, I think it makes sense to diversify. The markets have become so efficient. I don't know how anyone would be really confident to put all their money in one stock. I certainly wouldn't put all my money in NVIDIA right now. It's a great company, but boy, it's expensive stock. Might make some sense. There's some really cheap stocks that look really cheap, but they may be going out of business. So I could make 400% or negative 100%. I don't know who's so confident that the market is absolutely wrong on a particular stock that they're going to put all their money in one stock. The whole familiarity versus diversification, I think computers have solved a lot of that for us. Plus, indexing has proven itself to be so effective. Now, I don't know if you looked at Keynes and O'Neill, would they have beaten indexes? I doubt. Maynard Keynes was all that great of an investor. Who knows? We never get those numbers, so who knows how good they were back then. No one knew what indexing was back then anyways, so you wouldn't have been able to do it if you wanted to. So familiarity and benefits concentrated portfolios, probably not a smart move today. The problem is, as well as diversification works on the security level, it doesn't work consistently, and it works the least when you most need it. During a crisis, there's a lot more systematic risk in stocks than when you don't really need diversification. It's just the negative side of finance. Betas themselves are unstable, just that whole idea of how much, so first of all, how much systematic risk, the percentage keeps moving, and then the firm's sensitivity to systematic risk changes. So all of your inputs keep moving around. So you don't have a lot of confidence. You can't just look at history and go forward. I'm not really sure, boy, Markowitz passed away this last year. I would love to have sat down with him and asked, what did you actually do in the 1950s to come up with the standard deviation and correlation of every single security in the stock market when you didn't even have a calculator? Do y'all even know how they did things back then? Did he just have 50 PhD students and they just were all their crunching numbers? So I don't know. It seems completely, almost impossible to do numbers. So my guess is they may have been using 3 years of data, 5 years of data. Just think 5 years of data just seems overwhelming. Times 500 stocks, 5 years, that's 60 pieces of data. You got to subtract each one of those 60 months by all the other 499 stocks to get, and you have to get the average. How did they do that before we had calculators? It just doesn't make sense to me. So I can see back then you had no choice but just to rely on recent history because you just couldn't do all the calculations. But now we can do those calculations and we can see how unstable those numbers are. I don't think he knew how unstable they were because he could only calculate them once. So we now know these really critical inputs for risk management are very unreliable looking at history. They change so dramatically. But I still think it makes sense to diversify at the individual stock level. At the asset class level, I'm not so convinced, even though every financial planner says, diversify across asset classes. Not everybody agrees with that. Jack Bogle, he was head of Vanguard, and he didn't believe in buying non-U.S. stocks. That would have been really smart the last several years. But his argument was Coca-Cola, Exxon, those are international stocks already. You're getting a lot of international exposure by buying U.S. stocks. He's ignoring the currency impact on risk and those kind of things. So not everybody believes that. But my problem in the U.S., as we talked about last class, most U.S. citizens, their whole idea of diversification is stocks and bonds. And that works really well until when? Inflation. Yeah, inflation kills that. So what else? Yeah, we're going to talk about that. So yeah, you've got something that works really well unless inflation shows up and then you're sunk. That's not, sounds like a pretty weak diversification theory. So correlations are unstable, and they shoot up during a crisis. So when you need that diversification the most, they help you the least. With the exception of long treasuries. Long treasuries do great in a crisis unless the crisis is inflation. But yeah, long treasuries did great in 2008. There's times when they really do help you quite a bit. Standard deviations are unstable over time. And then extremely rare events happen a whole lot more frequently than they should, according to the math that we're using. Now, there's a whole lot of college classes. I should put this on video. There's a lot of college classes that teach this stuff like it works perfectly. And I'm not so sure about some academic professors. They don't think everybody's doing it and we're all good. That, you go calculate a correlation, that's your number. You never have to worry about how unstable it is. You just use it. I've had professors ask, Ron, why do you do the rolling beta? Some of y'all see me do that. And so you can see how unstable it is. And they're like, hey, don't do that. It kind of messes up our lectures. But yeah, I mean, we're using assumptions that are very, very, very unstable. So all of our assumptions are unstable, much more unstable than the theory allows. Tonight, what I want to do, I want to finish up DKO in that discussion. I know I didn't record Tuesday nights, but I'll give you a link to a discussion from our previous class. And then next week, we'll go through the rubric for the question very, very carefully. But do take good notes as we go. Then I want to work on paper 1. Technically due on Saturday, but you have more time. But I'm hoping at least half the class will turn it in on Saturday so I can get them graded this weekend. But I'll give you a little more time for those that need more time. But tonight we're really going to bear down in teams, make it a little competitive on teams to see if we can make sure everybody leaves knowing exactly what to put in paper one. There's still students in this class that are not getting the templates for the papers or the essays, and I don't want that to happen on paper two. If we have the same results on paper two as we had, I mean, on paper one, we had on exam, some people are gonna have to probably drop the class because it's, so we gotta make sure you know exactly what goes into it. But let's listen to Malkiel. So he's talking about diversification. This first part, he's talking about bonds and stocks. So here he's saying, yeah, stocks and bonds are negatively correlated again. And what we said there is no, bonds and stocks don't have a correlation. Bonds and stocks react to environments in different ways. And when the environment changes, how they react changes. Doesn't mean they have an inherent correlation. In certain times they're positively correlated, sometimes they're negatively correlated. So the key is not what is their correlation, the key is what environment are you in. He ignores that entirely. And he's probably using long treasuries because he's getting a really, really negative correlation between stocks and bonds. And then he says, and gold is a great diversifier. And yet you look at his portfolio, recommends gold's not even existent in that portfolio. So he mentions gold and then doesn't use it. So that's where we were last time.
Who is his audience?
I don't know who he's speaking to here. This is back after the 2008 crisis. So it's coming about 2010.
When you say he doesn't use gold, can you elaborate on that one?
Well, he's going to show his recommended portfolio. It's bonds, U.S. stocks, and non-U.S. stocks. That's the only things he has.
So this audience is like a bunch of, if there are a bunch of clients, then wouldn't you want to give them?
I don't think he has clients. I think this is probably, well, I don't know. This is probably the university somewhere. He's speaking at a conference, maybe.
Anyone that pays, it's like, why would you give like the most supporting piece of evidence and not?
Well, if it depends. If it's a university, you know, the fact that it's on YouTube and recorded, Dr. Murray can we make Princeton University author, blah, blah. Sarah says investment use, Australia, similar talk at SERP Associates. I don't know what that is. You can look that up. So I don't know who his audience is. Probably more likely financial planners than not, but who knows? It could be portfolio managers. I'm not sure. Sometimes, and sometimes they don't. That's the kind of point he's completely ignoring. Now, this is, I think, his biggest mistake. Again, he's not here to defend himself, so I probably should have blocked out his face on all this. But here he's going to say, hey, yeah, it's true. U.S. stocks fell, emerging market stocks fell, high correlation. However, if you look at the entire decade, emerging stocks were up 10 and U.S. stocks were 0. So even though they moved together over the whole decade, emerging markets helped you. Now, what is he telling you there? That particular decade, emerging did better. Does that mean going forward, you have emerging markets, it's going to help you the next time U.S. doesn't do well? That's the argument he's going to make. Could it just happen that was a decade when emerging did better than U.S.? So we'll see. His recommendation is pretty radical. So that's emerging, that's developed. Now you tell me, are you happy? When you look at returns that ignore risk, isn't it kind of what he's saying here? Is, hey, yeah, it was a horrible ride, and you went from up 200% to up 20%, so you lost 180%. But boy, you should be really happy you were there. My guess you were really happy here, and you're really unhappy here, and here you're just like, I'm getting off the roller coaster. But I don't get his argument. I think it's really tough to make an argument with one particular decade as if that's going to give you some solution for the next decade. Because every decade is so radically different. In the 70s, US was not a good place to be, and other places were great places to be.
Oh, I was gonna ask, you talked about how corporate bonds did not do well, or like American corporate bonds. How were like foreign corporate bonds doing?
I can't tell you on that. This decade, emerging debt was a horrible place in certain places. The developed market, that just really depends on what the US dollar was doing. Then had to go back and look. That's more of a US dollar than it is anything else. During the crisis, my guess is government bonds are doing great everywhere, just because everybody's fleeing to safety. So it's hard to know.
So at the lowest point, up there when he was down on your neighbors, and he was still up 20. So is he saying that that's still pretty decent?
What he's saying is you were diversified because emerging got you 10, US got you 0.
Right.
Now that's 10% over a decade, so it's not all that particularly great, but yeah, I mean, he's saying, yeah, you protect that. What I'm going to show you is the lines after this, all right? Because you might find that interesting. So he's kind of arguing that, hey, put emerging markets in there because then if the US doesn't do well, you'll have this. But I want you to think about if you had done what he said to do here, how happy you would be. If you would really say, hey, man, we were smart to have emerging or diversification. It's annual return, so it is a decent return. I think it still holds water. Okay, so let's look at. I think he's about to show you. I think this. So he's about to show you his recommended asset allocation to get diversified. 30%. I can't read the number. 30% bonds, 33% US stocks, 17% emerging, 17. He wants to put half your portfolio in non-US stocks, half your stock portfolio in US stocks. All right, that's what he's saying you should do. And if you look at it, you'll be way up here versus if you had just done that with US stocks. What does this picture look like if you had done what he said? The two lines would be exactly switched. You would have done much, much better if you're in US stocks and have avoided non-US stocks. But anyway, so I think you got to be real careful if you try to make a point based on one decade about how to invest, because every decade is so. So what's the argument against this? Is reversion to the mean. Sometimes the best thing you can do is invest in the lowest performing and avoid the highest performing. It's the exact opposite of what he's proposing here. But this is a really radical. Where do y'all see his gold allocation here? What's his gold allocation? It's not even there. So he mentions gold, but then he leaves it completely out. Yeah, and I don't like that argument for an allocation is what if you had? Because we're not talking about the past. How should you invest if you could get the past? I would put all of my money in call options on the best performing stock. That's what I would do. Is that a good investment strategy? Well, if you know exactly what's going to happen, yeah, it's a great investment strategy. So does that sound like what we talked about on the borrowing to invest? Why do pension put money in the stocks? Well, because they've done so well. So you're arguing, hey, it worked, so it must be a good strategy. I think that's a really weak argument in finance. You remember that chart when it went from 280 to 20, and you have 17% of your portfolio in that? When's the last time you had something that was worth $250 and it fell to $20 and you had, 1/6 of your portfolio in that? Would you think that was a good allocation? Sounds pretty radical to me. And that's strange to me too. It's not all that great, but that's what I'm recommending. That bothers me as well. I heard a guy on the news once. He was predicting a massive bear market. Really aggressively. Yeah, the stocks overpriced are going to fall. And so the interviewer said, well, how do you invest? Oh, I'm 60% stocks, 40 for bonds. I just keep a steady allocation. It's like, well, do you think stocks are going to sell off or not? Yeah, they're definitely going to sell off. And what are you going to do? I'm going to stick with my 60-40. See, doesn't make sense. I think there's a bomb in the building. It's going off in 10 minutes. What are you going to do? Oh, I think I'll stay here for lunch. You know, I was thinking about going out on the patio for what? It's like, wait, what are you talking about? It makes no sense.
The one that I suggested, the old one.
So you're about to hear it worked, so it must be good. I think that's a horrible argument for any investment finance strategy.
That's the calculation. You rebalance every January, you have the first one on portfolio, and what you notice is you almost double your money during that decade. The 5%, because that was one of the worst decades for investors. That's one of the worst that you can have to start to think about going back to the 30s. The thing that you get the worst investment for that. But I would say that diversification does work, and so
Right, so here's the US markets. Since I did this, starting from the time he did this presentation, here's US stocks. Here's developed market stocks. And here's emerging market stocks. He wanted you to put 1/3 of your money in these. Do you really think you would be happy that you didn't have the, wouldn't you have noticed it somewhere around in here? It's like, my word, I'm really not doing well. I'm not saying that's the wrong allocation. I'm just saying the particular decade he picked worked really well. Do you think he would be making the same presentation right here? You think he'd be making the same slides? Probably not. So, huh? You mean on these? I mean, these are really cheap. We're talking about the dashboard team meeting on Wednesday. Yeah, developed market stocks are cheap versus the US.
also for the US stock,
Oh, off of this?
bouncing off there, and you can flush down.
Well, I don't predict markets. The US stock market is expensive by most measures. So it could come down another 20, 30, 40%, no question. These markets are cheap. So if I was using his argument, I would say, you know, put all your money in US stocks and avoid these. I might argue the exact opposite. This is the expensive market. These are the cheap markets.
I'm not talking about that. He's talking about the price action show, because I need to know exactly. Intraday trading is a little bit different, though. So he's-
Yeah, I'm not talking technicals here. I'm talking valuations, but he's talking risk and diversification. I mean, if you're going to put some moving averages in here and try to say the US is going to bounce off this or whatever, you can make those type of arguments. This is log normal too. I made it. I think this is log, or maybe it's not. I can't remember. But log normal helps because you can see the percentage changes a lot better. Yeah, this probably isn't log normal, but so I'm not making from a valuation standpoint, you're probably better off with developed markets. But you can also make the argument that the US markets are very different than developed markets. Europe hasn't done anything for years. And for very good reasons. There's good reasons why European companies don't grow as fast as US companies. They've got a lot of headwinds. So from an allocation standpoint, which is what he's talking about, what do you do the next decade? Not what you do this afternoon or tomorrow. What do you do next decade? His argument based on what he just said, would be put all your money in US stock market because it's the one that's performed the best the last decade. I don't think that's a good argument for an investment. Valuation, I think, is important. How much did he talk about valuation? He didn't even mention valuation. So valuation is an important one too. Where are the US stock looks expensive? Emerging markets look cheap. Developed markets look really cheap. The US dollar has been strong. That's another argument for why you might go into these other markets. I'm not saying you shouldn't be in these other markets. I'm just kind of reflecting that the point he did his presentation, recommending putting 40% of your money into the yellow and orange lines, I think doesn't work well.
Can you explain what the log normal means?
Well, if you do the log normal, a 10% change is the same size all the way along the chart. If you don't do log normal, a 10% change here, like that could be 10%, and that could be 10%. Because of the compounding effect, 10% looks really small early in the chart and looks really big. When you do log normal, a 10% change is the exact same size in the chart. So you see the volatility more clearly. This looks really not very volatile, does it? But it could be really, really volatile because you're massing things just because of the compounding effect, because this is such a massive number. All right. All right. So I think part of his trouble, he talks about gold and he doesn't have gold in his recommendation. But so much of his argument is that particular decade. And every decade is so different. What do you do today? I've been telling him this is probably one of the most difficult times to invest in stocks today. The stock market looks expensive in the US side. Europe looks cheap, but has been cheap for so long and has been such a disaster from a growth standpoint. Emerging countries, so much of that is China, what you think China is going to do. It's a tough time to invest. And then we got a new president and we got Taiwan and China, we got Russia and Ukraine, we got all these things going on. It's a tough time to invest. I'm not going to tell you go 100% US stocks because it's what's done well the last 10 years though. So his argument was diversification works because it had a higher return. That argument somewhat falls apart because the next decade it was the exact opposite. So not that you draw this graph on your paper. All right. So we'll go through this again. We'll go through the rubric for the essay. But the bottom line is for individual securities, diversification definitely works. You're better off having 50 stocks in your portfolio than having just one from a risk standpoint. But that diversification doesn't work well in a crisis. It works much less well in a crisis from an allocation standpoint for asset classes. I think the jury's still out. We were talking last night in Investment Society, as finance tries to make things more and more liquid by sticking real estate into traded securities like REITs. They want to put private equity into ETFs. They want to put timber. They want to put infrastructure. They want to put all this stuff into ETFs. As you make things more liquid, volatility goes up, correlations go up, you lose the diversification benefit. And so the whole diversification argument, we're making it worse because finance has gotten so creative. Now, why are illiquid assets less volatile? It's probably because they're so hard to trade. You don't get that price action that you get with liquid securities. So Matt Freund at UTSA always says, in a crisis, you sell what you can, not what you should. So the most liquid stuff is what gets sold because you can sell that. So what happens to the prices, the most liquid stuff? They all move together and they all fall dramatically. The illiquid stuff doesn't move because you just have to sit on it. If you're in a crisis, you're not going to say, man, I better sell my house this afternoon because I need some cash tomorrow. You're probably not going to do that. But you can sell your stock portfolio, you can sell your bonds. If we put real estate into a stock that you can now trade, what's going to happen? Now you're going to trade, you can trade your house. If your house is in an ETF, you can now sell your house pretty fast. What does that do? It increases volatility, increases correlations. In a crisis, people just start selling stuff. And so, yeah, I think we're making the diversification argument worse and worse and worse by being so creative in finance. Not that I'm anti-liquidity, it's wonderful, but there's the downside of liquidity and that it makes risk management much more difficult. All right, so now we're going to break up into teams. I'm going to give you an outline for the paper. You have your papers out, right? You've written your paper, you have them out. So we're gonna break up into teams by the banks that you have. So I don't know where the different banks are. Some of the banks are too big, so you have to bring separate groups. So try to get in groups of 4 or 5 with your bank. We'll organize that. So I'm gonna give the outline, and then the challenge is we need to add more stuff to this outline. So if a team adds an important component to the outline, they get a point, and we'll see which team can do the most. So let me give you the outline, and then we'll break up into teams. So your first section has several components. You're gonna do, you want an intro to the bank. Who is this bank? Not massive amount of history, but who is this bank? What are they known for? I usually with a bank will give their total assets, maybe their market cap. You know, these are big banks, right? We're talking trillions of dollars in assets. We're talking market caps that are in 150 billion kind of range. These are big banks. Give some background. I would probably have a section. If I were writing a paper, I'd love to write this paper. This is a really fun paper. It's really valuable paper. I would probably talk about their mission and, and core values. Who do they say they are? This is what we believe. You know, I mentioned JP Morgan. We have a fortress balance sheet. Yeah, I mean, they're talking about strength. But their mission statement doesn't mention risk. Most firms have a mission statement and core values. Core values are just like integrity, whatever, those kind of things. And then we're gonna get into the risk management philosophy and process. Can you find a philosophy statement that is bank-wide? How does a philosophy statement start? It starts off with "we believe." And JP Morgan, we believe, what do they say we believe related to risk? We believe risk management is a core function at this bank. We believe risk management encapsulates every action we do at this bank. Whatever they say something about risk. When I do papers like this, I like to do cutesy things like do a search on the word risk and see when's the first time it comes up. How many times does it come up? When's the first time it comes up outside of the risk management section? Who's saying it? Is it a quote? Is management saying it? Those kind of things. Try to figure out how important is risk management to this bank's operations. You're trying to answer that. And then we have processes. This is where you're going to spend quite a bit of time on the process. You got the who and the what here. So on the who, you've got people and you have committees. People, we're talking about the board, management, CRO, audit committee. Those are the key ones. Let's see if y'all can put another one in there. I'm missing one in that group. So I think every one of your banks has a CRO. And imagine any of you don't. It's pretty common. And then the committees, this is probably where you're going to put a table. And what are they? And generally, what do they do? And the what is process. This is where you have roles and ongoing processes. You may not get as much of that specifically in. So the audit committee reports directly to the board or directly to the board's audit committee around the CEO. So make JP Morgan's internal audit. When it talks about risks, they go right to the board's audit committee. It doesn't go to the CEO, doesn't tell the CEO what they're doing. What is that process? And then you have the hierarchy. I don't know how to spell hierarchy or something like that. I don't know if that's right or not. Yeah. You ever do that? Put a wrong letter just to see if it's doing spelling. I don't know what else y'all have. Y'all can probably add some things here on process. How did you look at your bank and figure out what was going on? That's the kind of thing that you're looking at. You have the people, the players. What you're trying to do here, to the extent you can. I realize it's pretty tough, but what did they actually do? My most interesting thing on the board is what is their background? You could spend quite a bit of time there if you wanted to. I think some of you have tried it and it's pretty tough. You get the board members who like, are they from banking? Are they from industrials? Or who are these board members? They have 11 board members. Yeah, it would take you a while to look all of them up and get their backgrounds, but who are these people? Who's the chief risk officer? Someone looked that up to see, or did they come from a finance background? Did they come from a risk management background? One key, I think, with the chief risk officer is the fact that these banks are so complicated, that trading is a big part of the risk of these banks. And if they don't have that background, I mean, you can think about it. Accountants are smart people, but this is not their training. Trading is pretty tough. Is the CRO a previous trader, or is it an auditor, or is it, who knows, risk management? Risk management even has less of a background in this. So those are the kind of things that interest me, because the CRO, their power is really dependent on their understanding of what's going on. Otherwise, they're just going to be steamrolled. They say, hey, we shouldn't be doing this, and everyone's just going to ignore them. All right. And I have the same issue with internal audit. They tend to be accountants working in the bank. Now, typically, these internal auditors, they understand the bank better than accountants at other firms, no question, but it's still, we're dealing with really complicated things. This is really important for your final conclusion, because you're going to ask, can this risk process actually work the way it's designed? Do you have the right people in the right place that can actually do anything? So this may be the most varied part of y'all's paper, because there's so many ways you can go with that. We'll see if y'all can add to that. You might have a section on the universe of risk and high level processes. Don't go overboard on that. They're gonna have operational risk. They're gonna have credit risk, which is known as half of the risk section. What is their universal risk? Some of your banks will actually give the universal risk. I would put that in the paper. What is that universal risk? They've all seen that, a list of risk. I was looking at Knox paper. He had a good list of, I think you could call them emerging risk, right? So JP Morgan had emerging risk. That's kind of interesting. AI, those kind of things. Yeah, that would be interesting to talk about. So, all right, that's my first section. And then you're going to be doing market risk. You will have, if you want a decent score on the paper, you will have how many sections here? 3. What are they called? Find, measure, mitigate. Yeah, most of the paper I'm seeing are not doing that. You will be in a lot of trouble if you don't do that. I want you really precisely. On define, I don't want your definition of market risk. I don't want I've seen my definition of market risk. That's really boring to me, because I see that every semester. Guess whose definition I want? The banks. You probably want to quote them, all right? Don't give me a generic, don't go out and Google market risk and give me Investopedia's definition. Investopedia doesn't work for Bank of America, all right? I want their definition, all right? Be real clear on that. Measure, I'm going to give you the ones that I would think of. Value at risk, stress test. Those are the main ones that you're going to see. To see if y'all can put some others in there. Those are the main 2. The stress, the VAR back testing and the stress test, there's several of them. On mitigation, this is probably the weakest of the example papers I've seen. Some of them just haven't gotten to this yet. But on the mitigate, what's the number one mitigation? We've been talking about it. Well, diversification. Correlation. It's what we've been just going over. Oh man, Bill Gates doesn't even know it. Diversification. I still can't do it. I'm hooked on phonics, but it's not helping me. All right. That is everybody in finance, diversification. You'll see that in their bar schedule, right? You also have derivatives. You might have securitization. I don't know about the others that you have. Here's where you can really help us out tonight, and what are other ones that y'all are seeing. I can't remember ones I gave you out earlier in the class, but there's. So if I were writing a paper, I would have a section bolded title that says market risk. I would have the word define bolded, probably a quote from the bank, and then maybe some other discussion on what that means. Maybe they have 3 paragraphs where they give a definition and then they kind of discuss it. I would maybe quote their definition and then put in my own words what those other 2 paragraphs are saying. You know, get those other 2 paragraphs down to a sentence or 2. I would then have value. I had measure as a big bolded. And then I would have valued risk bolded and talk about valued risk. And what else would I have? Tables. Make sure you're bringing tables from the bank into this. That's really, really, really critical. Same thing on the stress test. Bring in tables. I've seen all of your banks have tables on VAR, and all of your banks have tables on stress tests. What does the table on the stress test look like? Just like you did on exam 1. What if interest rates rise 100 basis points? What if they fall 100 basis points? That's a stress test. What some of you are going to find is they have multiple stress tests and they call them all different things. Economic net worth, economic earnings. Those are all stress tests. Anything that says, hey, what would happen if this happened? Where you don't have probabilities assigned, right? There's just scenarios without probabilities. Those are stress tests. And then the last section is your conclusion. Your conclusion is your assessment, quality, and strength of the process. Here it's pretty tough trying to figure out what you think's going on here. Most of you are going to think, wow, it's JP Morgan. Of course it's good. That may be the answer, or maybe you really can't say more because you don't have the inside information, but try your best. I really, at this point, get it to those committees. Are the committees well defined? Is it obvious who does what? Do they have power? You remember AIG going under? AIG had the most impressive process. All these wonderful measurements got filed in notebooks that no one looked at or did anything with, but yeah, it looked wonderful. All these numbers couldn't have beat them on the graphics, but no risk taking was actually controlled because everybody's doing what they're going to do anyway. And then the last question. Too big to manage or too complex to manage. These are huge organizations, massive global organizations, especially Citibank, very, very global organization. And you really manage these risks in a way that, you make sure something's not blowing up. One thing I'll add, so I'm going to cheat and add one up here. I might, in the introduction, give an example of a big headline risk. I can't say they all have one. Goldman definitely does. Bank of America definitely does. Wells Fargo definitely does. My guess is most of them do. Citibank and Bank of America definitely in 2008 were serious issues. But if there's something obviously going on, the well risk at JP Morgan, the Malaysia risk with Goldman, the account scandal at Wells Fargo. All right, so there's my outline. All right, let's talk about what y'all are seeing. So try to find a seat somewhere. Any team want to report something? Whoever goes first gets the credit. So who wants, what are y'all doing in this first section? I don't have listed here. Leo? Everybody just, separately? Okay, before the board? Yeah, you could definitely. Yeah. All right, so CEO as an important player here, probably more important than the CRO. All right, good. What else are y'all seeing? Sebastian?
This is kind of specific to Wells Fargo, but for people, we have a chief accountability officer,
Oh, okay.
and that one was mostly done after they have their accounts scandal. Matters that.
So this is more for the operational.
Yeah.
All right. Yeah, if you have any key people that, you know, are specific to the risk management process, you think you need to bring out, you certainly can do that.
For Bank of America, they have their CRO is on sabbatical right now, and they have someone just kind of filling in for him while he's gone.
Oh, wow.
Yeah.
I don't know. You did sabbaticals at corporations. That sounds like a university. So, okay, interesting.
He's on 6 week sabbatical as of January. I can find it, but sometime in January. He's back now, but.
Okay. Wow. Okay. I don't know how you handle that, but yeah, I mean, it's.
The guy they put in place was CRO for like a year, a little like 9 months.
Okay.
But now I think he's, but yeah, it's weird.
Makes you question the importance of it. So,
Exactly.
okay. The Reed, do you have something or someone? No. All right. Let me show you, none others. Let me show you this paper I showed y'all before. One thing I noticed in her paper was quotes. I don't know how you get quotes. Here, the CEO quote. So you might finding a quote from the CRO would probably be pretty tough. But if you can, if you know their name, they're on Bloomberg. You know, you could try emailing them, asking them. You know, I'm doing a paper on your bank. You know, what is your risk philosophy or something? You know, you could try it. Pretty impressive. But quotes could definitely be a powerful tool. They quoted Elizabeth Warren. Obviously, this is, you know, obviously Wells Fargo, so they had at this time a lot that they could do. You notice here on the process, and I've seen this in a lot. So I'm surprised about this is the three or whatever. Have y'all seen that in your banks? So you would probably you don't want to, you know, if it's 6 pages, you don't want 6 pages. Can you capsulize that into 3 or 4 paragraphs? What do they mean by that? Is that the board, the audit committee, the corporate committees? I mean, you got the board, the audit department, the board and the board committees, the audit, and then the corporate committees. Some of them have the board, audit, the corporate committees, and the line of business, LOBs. You all seen that? Line of business committees. I might put that in there. Some. Any of y'all talk about that one? That's kind of a big one for some of the others. So they have something like that. I think probably half, if not more than the banks have something like that. Levels of defense. What does each one do? This one's a little bit overdone. I would say a little bit bunch. It goes into the compensation structure of the board. I would have a section on the major committees and talking about those. Definitely not all of them because they get a little messy, but you definitely want to talk about that. All right, do y'all feel comfortable with this first section? If your first section is 3 paragraphs, how do you think that's going to go? We're not going to work too much. What do you think it's going to be? You know, definitely a few pages, right? It's going to take you a while. You're trying to capitalize this bank in a few pages. Like, what is their risk management? This, I think, the most important thing the bank does, and it's a big section of this. So, all right, let's go to the next one. This one's a little more straightforward. We can't do much on the define. Some of y'all have a little bit of struggle. Some are talking about liquidity risk. That's not really required here, but some of y'all, they separate interest rate risk from market risk. You're gonna just talk among yourselves. If your bank does that, you'll probably have to do those either in two different sections, or you're gonna have to try to figure out, do they do anything different between those two sections? They're probably using value at risk in both of them. They're probably doing stress tests in both of them. So you'll have to decide, and y'all can talk among yourselves. Are you doing a section, if they have interest rate risk separate from market risk, are you gonna actually have two sections in your report on that? Are you gonna try to combine them in one? You can talk about that. But really what I wanna know is, can y'all add, I kept this list pretty skimpy. And then one thing I want you to decide is on VAR back testing, where does that go? Is that a measure or is that a mitigation? All right, so figure that out. So I'll give you about 5 or so minutes, maybe 10 minutes on that. We're getting close to time. So go, let's see, we can go. We got 3 teams that give me some good stuff here. All right, so go, talk among yourself. All right, let's report out. So everybody pay attention up here. All right, anything y'all saw unique about the find that any of you are doing? Any of y'all find quotes for management, Brian?
For Citibank, it provides our market risk between trading portfolios and non-trading portfolios.
Yeah, you might see that. Are you gonna do it as separate discussions, or are you gonna put it all in one section? Yeah, that's the reason I left credit risk out, because credit risk is such a pain, because they do commercial loans, they do consumer loans, they do mortgages. And they're doing similar stuff, but they're using so different jargon. So yeah, Brian, you have to just decide. Sometimes it's easier just to do it as 2 sections because it just makes it easier to summarize it. If you do it as 1 section, you almost have to line it up and say, hey, is this the same as this, or are they doing something different? So it can get a little tough. They are probably, Brian, doing value at risk and stress tests similar in both places, right? Just maybe calling them something different. All right, so there you definitely have to say, how do you break it out between sub-risk? That's not sun risk, but sub-risk. That's always an issue in these banks, and it is the reason I left credit risk out. All right, measure. What did y'all have in measure other than VAR and stress tests?
For JP Morgan, they also did profit and loss drawdowns.
Okay, so drawdowns, I consider those. What did Tristan? What did yours was called?
Like profit and loss drawdown limits,
You had another term in there, but
EAR.
earnings at risk.
Yeah.
I consider all of those stress tests. But if I were doing it, I would probably put it in a separate category and say, in addition to stress tests, I do other things that are really stress tests, but more specific, and I might bring it like that. Factor sensitivity, so that's kind of the VAR backtesting, right? Is that what they call it, factor sensitivities? Do you know what the factors are? Yeah, factor sensitivity is kind of, it's kind of a stress test to see which are most impactful. I would put that under measurement. They're trying to say, hey, we're spending all this time on these 10 risks, but when we stress them, this one has the biggest impact, and that may change over time depending on where the yield curve is. I still put that under stress tests. The reason I put these under stress tests, so my distinction between value risk and stress test, value risk is a statistical calculation. 1% of the time we expect this, 5% of the time we expect this. Stress test ignores probabilities. Says, what would we lose if this happened? We don't talk about the probability of that happening. We say, hey, if this happens, this is what would happen. That's what factor sensitivities are. That's what drawdowns are. That's what earnings are. You're not worried about probabilities. You're just asking, hey, if interest rates fall 100 basis points, we're not saying there's maybe a 10% chance they do. There may be a 50% chance they do. We don't know. But if they do, this is what we'll lose. All right. But you can certainly, you might you know, you have to figure out, you introduce this stress section. You might say stress test, which includes what the bank calls stress tests, but other things that they do that are very similar. You could introduce it like that and then have stress tests, earnings drawdowns. Have any of y'all seen the word economic earnings? Is that in any of y'all's? That's the similar type of stress test, economic earnings. What would our earnings look like in this situation? What is economic earnings versus what? When you see economic earnings, you mean versus accounting earnings. What's the difference between economic earnings and accounting earnings? Economic earnings, everything's on a market value adjusted basis. You just mark everything to market. Any other measures that you are seeing? Where did y'all put VAR back testing? Under measurement? Is that similar to a factor sensitivity?
The accuracy.
Yeah, how good is VAR in predicting or distribution? I would put that under measurement. When you're testing the measurement, I don't know why Bill Gates doesn't think back testing is a word. You're testing the measurement, see if it's any good. Yeah, that to me is measurement. I would not put that under mitigation. Any other measurements y'all are seeing? At USAA, this was essentially a value risk and stress testing. All right, what about mitigation? So that means all of your papers better have VAR and stress tests in it, all right? I'm not saying make sure you discuss at least one of them. Make sure you address, of these two, make sure you discuss at least two of them, okay? Mitigation, same thing. On these first two especially, all of your banks, correlation, diversification is going to be in there. All of your banks, I know for 100% sure. And I'm quite sure all of your banks use derivatives. And I add securitization because you'll see that a lot of times that fits more better on a credit risk, but it can fit here. Definitely, especially interest rate risk. What else did y'all see on mitigation? Well, that's yeah, that's part of the correlation.
Mitigating risk also be like, you also touch on like innovation as a way of mitigating.
Innovation.
Yeah, like, yeah, that's not necessarily.
AI is an interesting one. You might, yeah, you might have a section at the end on innovations. I don't know if AI fits under measurement or mitigation either, though. That's kind of a tough one to say. If they're doing some interesting things, I don't know if I would put that here or maybe put it in introduction. If you're like, you know, it's not on emerging risk, you might have emerging risk and emerging innovations or innovations. Yeah, there could be a place for that. That would certainly be a good thing to add to the paper. If they're specifically saying, hey, how AI is, now I think with JP Morgan, they were talking about AI as an actual risk in their universe, not so much as a measurement, but it could be both, right? AI to help us measure. I'm trying to think of how AI is going to help us mitigate, but maybe there's a way to do that. But all right, other mitigations.
Economic hedging.
All right, so economic hedging, I would think is derivatives, but if it's something else in there other than derivatives, put it in there. But what are those things? What are they hedging that they're not using a derivative to do it? And then, can you figure that out? Do they say that? Some banks just say we do hedging, and you're like, well, what does that mean? It could be derivatives. It could be duration matching, right? But I haven't seen your banks, what we did on exam one, all the banks do it, but I don't see them talking about it in the annual report. But I do, y'all definitely bring it in. Do they actually calculate the duration of net worth, the duration of assets, the duration of liabilities? They do, but my guess is they're not saying that. That would be an economic hedge, right? You're making sure, but how are you getting that to work? What did we do in exam one? We did a swap, right? So it kind of, to me, It's hard for me to think of an economic hedge that's not using derivatives, but I guess it's possible that there's something to do. Maybe they are actually saying, hey, let's stop doing 3-year CDs along those lines. But so when they say things like, that's a good point from Sebastian. If they say things like that, is it really something new? Kind of like with the stress test and the drawdowns, is it really something new? Or are they using different terms for the same thing over and over again? Other things in mitigation that y'all found?
Collateral?
Collateral is really, really good for credit risk. Collateral under market risk, I think is, I don't know. If you want to make, why do you hold collateral? It's really for credit risk, isn't it? Do you hold collateral for market risk? That one's a little tough. So I don't think so, but if you want to make a case for it, you know, try it. Definitely would work.
Securitization.
Huh?
Shouldn't it be called, I should recommend.
Yeah, securitization, you're really getting the assets off your books. That helps you with interest rate risk because they're not on your books anymore. Interest rates change. You got a 30-year mortgage. You don't own it anymore. All right, so you see this part of the paper is not that complex. Make sure you have the tables. Now, I've seen a lot of students on derivatives. They do put tables there. You could certainly do that. Most of these banks do have a table listing all the derivatives. You could certainly do that just to show how extensive it is. It'll probably show you the notional amount, maybe the number of contracts or something. To me, what I think is interesting is which ones. My guess is swaps is the biggest one. But look and see. Are they using swaps? They're probably not using options extensively, but they may a little bit. If you could even get real detailed, are they using swaptions? Are they using futures? Most of them are using swaps because swaps are just much more flexible than futures, but they might use futures. So look and see what they're doing from that standpoint. So this part is really not that massive. On the student example paper, that was really the weakest part of her paper because she just didn't really get into it as much. So you can see here, economic hedging, what does that even mean? So that's probably where she probably lost most points. She does have some tables in there. But yeah, of her entire paper, that was probably the weakest section. This is also the area where you're probably struggling with some jargon. They're saying stuff and you're like, is this new or is this the same thing? And it's frustrating. It's frustrating for me too, because students come to me and it's like, that's a term that only Citibank uses. So I don't know what it means without me reading the entire annual reports. So it's not like they're using a generic finance term we all use. They're coming up with their own term.
With interest rate risk, other than following the defined measure of mitigate kind of topic, if we were to separate it, separate the subject itself, is there anything else we would recommend?
Well, essentially with interest rate risk, I doubt there's a third one besides market and interest rate. I would, under the define, I would list the components. And it probably is interest rate. They probably have credit in there. So credit is interesting. Credit is kind of credit, but it's also a price risk because when a firm gets downgraded, that's a credit risk, but it's also a price risk because the price falls. They may have commodities. They might have equities. They might have currencies, but I would, now most of that is in the VAR table, isn't it? Have y'all seen the VAR table with lists all those subcomponents? Everybody see that? So that somewhat helps you there. If you want to define what does it mean? So credit risk kind of comes in here just because credit events cause price events. So there is that overlap. Interest rate changes cause price events. That's why interest rates comes in there. So you might under the define say market risk. When you look at it, includes all this. You know, credit risk is a much bigger process, but it does have an indirect impact on market risk. I want to give you a good template. So if you talk to these banks or you get in an interview, that's why I'm so picky on define, measure, mitigate, and what is measurement, what is mitigate. It makes you sound so intelligent in an interview. You can keep those terms clear in your mind. This is the way banks think. It really helps. And the biggest problem I've had with the papers is students who just merge the measure, mitigate all together and without really distinguishing, they're two different things. Measure and mitigate are not the same thing. So make that distinction. Your banks may not make that distinction. They may mix them all together. So you've got to draw it out like, oh, now I'm talking about mitigate. So we measure and then we do something. Mitigate is you do something. So you go out and you buy a derivative. You know, you make sure that the different operations offset each other. So when you're looking at your risk, you have that diversification. You make sure you don't have everything all in one of these risks. All right. Then on your conclusion, well, we're out of time here. On your conclusion, do your best. I know it's tough. It's intimidating to try to have an opinion on something that's this complex, but have an opinion. If you're not sure, flip a coin. Heads, they're really good. Tails are really bad because you could probably make an argument either direction at this point. All right. All right. So Tuesday, we're having a walk so you can watch the videos. I'll get you the videos. You don't necessarily have to watch them Tuesday. You can watch them after you get the paper done. The paper's due Saturday at 5 o'clock, but you can have until the next Wednesday if you need to. I just hope, do y'all think any of y'all will turn them in Saturday? If I have some to grade, that would be really, really helpful. So any questions on all that? I have it in the email.
You come into class with this.
No, we have people walking. Yeah, we're having dinner on Tuesday too.
I don't think they understand that.
No, they know, no class Tuesday, right? Y'all know that. So I'll put it in the email. I know I didn't do the Zoom on Tuesday, but I'll get that video out. I'll recreate that video for y'all.